Welcome. We're excited to have you here today with Proactive Law's presentation on the Dynasty ILIT and Advanced Life Insurance. So we're going to talk about some exciting stuff. I want to mention a little bit about why proactive law. Proactive law is all about taking steps in advance to prevent complicated things from happening later on. It's kind of like proactive healthcare, so that you take measures, eat right, exercise, and so forth, so that you don't get sick. And if you do get sick, you get better faster. So we're going to talk about some legal things. And one of those is this Dynasty ILIT. ILIT stands for Irrevocable Life Insurance Trust. So I want to begin right off the bat with who the heck needs this thing and why should I care? And I want to, by the way, acknowledge I'm here with my esteemed colleague, Michael Koberlein. We're excited to be working together at Durfee Law Group and Probate Law Group and Estate Planning Law Group. Three different windows into the legal services we provide, focused on different but related areas of the law. So what is an ILIT? Who needs one, and why do we give a rip? In general, a trust is a contract that controls property over time, and there's three parties. And I'm gonna pop this little diagram right up here so you can see this. I use a triangle to describe a trust when we illustrate this for people, because there's three parties. There's the grantor, which is the person who creates the trust, the trustee, the executive that runs it, and the beneficiaries, the people that enjoy it. And traditionally, an ILIT was used for one big, huge reason. An Irrevocable Life Insurance Trust was used to keep the death benefit of life insurance out of the taxable estate of the insured person. So most people, I think, understand, at least to a certain degree, that when you die, in a few states, a diminishing number of states, but still a few, and at the federal level, there is a tax on your estate that as it passes to your heirs. And there's an exclusion from that tax. And one of the bizarre, weird things, in my opinion, about that law is that if you have life insurance and you own a life insurance policy on yourself, the death benefit is included in and taxed as part of your estate. So you might think, well, I never get that money. I have to be dead before anybody sees that money. Why should I get taxed on it? And you do, because that is the wisdom of the politicians who make those rules. So the way to avoid that tax is to not own the life insurance. So this ILIT, Irrevocable Life Insurance Trust, is a device that's been used for many, many years, for decades, for longer than I've been practicing, which is more than 3 decades. It's been used as a mechanism for getting the death benefit of life insurance out of the taxable estate. So if you have big life insurance policies that put you over the estate tax threshold, now these days, most people, the middle class, most business owners, entrepreneurs, even professionals, unless their estate is pushing $10 million under the current law, or even $6 million when it sunsets in a few years here, that's not going to be an issue, but it can be an issue. So big life insurance policies or special use life insurance policies, and we'll talk about that. Some other triggers when this Dynasty ILIT becomes significant and important is business issues. If you have complex businesses with lots of entities, if you have succession issues, we're concerned about multi-generational ownership and multi-generational succession issues, who's going to take over the business. So as a business succession device, it becomes very powerful, very important, and for creating cross-generational wealth. And then I guess a third category is when we're doing certain kinds of asset protection. There are sometimes when a trust like this is very appropriate and highly advantageous. So if you're going to create a trust, you'll notice that we've got these three parties on the diagram you can see here: the grantor, the trustee, and the beneficiary. And then listed underneath our triangle here are our assets. And I'm going to move this up a little bit so you can see it's a little better. So you can see that the trust can own life insurance. Obviously, it's a life insurance trust. but it can also own business interests and other things. And we're going to talk about that in some detail. When those assets get in there, there's a few ways for them to get in there. And one of them is gifts. And you'll see on our diagram here that we've got gifts coming into the trust, and then this little envelope that says crummy notices. What the heck is that? So years ago, it was a practice typical among high net worth families to form these kind of trusts and put assets in them and keep them secret. And the reason they would be kept secret is so that you could unwind it if you wanted to, frankly. And there was a dentist who had the unfortunate opportunity to litigate this with the IRS, named Crummy. And the outcome of that IRS litigation is this: for the gift into this Dynasty ILIT to be complete, two things have to happen. Number one, the beneficiary has to know about it. There can't be any secret gifts. It's got to be known. And the second one is the beneficiary must have a present right to take the gift. And if they don't have that, then it's not a completed gift, and the property that you tried to gift is still in your taxable estate. It's still going to get taxed, and it could claw back other things. So as a result of that, when gifts are made into this kind of a trust, there's a notice that goes to the beneficiaries that says, hey, you got a gift, and hey, you have a right to take it out. And there are some technical things that happen with that. There's some very powerful things we can do to minimize the risk that they will be vulnerable to challenge by the IRS. So assets can go in by gifting. We can form brand new business entities in these trusts. We can loan money to these trusts, and these trusts can buy assets. So they can get assets in a variety of ways, and we're going to talk through some of that. And by the way, with this Dynasty Trust, this Irrevocable Life Insurance Dynasty Trust, and I'm going to drop the life insurance, just the Irrevocable Dynasty Trust, or I may even just call it a Dynasty Trust. That's a term of art. It has a very specific meaning that we're going to talk about. But there's a couple of things. Most of the time, the majority of these that we see are established by the grantor, mom and dad, for mom and dad's children and grandchildren. That's what we see most of the time. But another very common device is spouses can form these for each other. And that's sometimes called a Spousal Lifetime Access Trust, or a SLAT. You can also have a third-party grantor. So grandma and grandpa can create this for the grandchildren and let their children in the middle have some control or access, or sometimes there can even be a completely unrelated third party that serves as the grantor. And there are some times and circumstances, particularly when we're trying to protect assets, that we use that. So these different types, again, set up for the children, set up for the spouse, or set up by a third party. And the funding, again, comes in by way of gifting or forming brand new de novo business entities, or loaning, or selling or purchasing assets in the name of the trust. So a big question that comes up is, well, how are these trusts taxed for income tax purposes? And we have some choices. And it's important to clarify that by speaking about income taxes, that's different than estate taxes. There's multiple taxes that can hit these entities. Estate taxes being one of them, and the way it's designed, it specifically avoids multiple generations of estate taxes, and we'll talk about that as we go through here. But also, there are some income tax planning issues. The bottom line is we can pick which party's going to pay the taxes. The default, and in fact, what I see in most ILITs, that lawyers that are not being as thorough as I think they ought to be, what ends up happening is these trusts end up having the trust be the taxpayer. And sometimes that's simple, and that's why it happens. But the downside of that is if the trust is the taxpayer, the trust gets to the maximum tax rate in a hurry. There's a very steep curve on when that trust reaches the maximal rate. In fact, after about $9,000 or $10,000 of income, the trust is taxed at the maximum rate. So option number 2 is you can have this taxed to the beneficiaries. And there's some specific rules that we have to follow to make that happen, but we can cause the trust to be taxed to the beneficiaries. And then a third option that's actually very popular is to cause the trust to be taxed to the grantor. So let me describe what this means. It's really interesting. You're going to form this trust for your children. You're going to put life insurance into it. And if this trust has any income, that income does not belong to you. It belongs to your children, or this trust for the benefit of your children. However, you are going to pay the income taxes on that income. Now, in many situations, we like that for a couple of reasons. Number one, it actually keeps the tax reporting simple. It makes the tax consequences of the planning we're doing tax neutral. So if we're setting up a complex business structure, we're not going to raise the taxes. We're not going to lower the taxes. The taxes are going to be what they've always been. And if you've been paying the taxes, you're going to continue to pay the taxes. But the other aspect of this, particularly in very large estates, assets in this green trust that we see here, this Dynasty Trust, are outside the taxable estate. So we want those to grow. And if that trust is recognizing or receiving income but not paying the taxes on it, it's going to have growth from all that income without bearing the burden of the taxes. And the taxable estate, the estate that gets taxed when you die, is going to be reduced by those taxes. So that grantor defective is what it's called. You'll see that up there on the by the side of the trust. Grantor defective means it's taxed to the grantor, and that's something we plan and are quite deliberate on. Now, if we're gonna set up this Dynasty Trust, it's going to be irrevocable, and that scares some people. Irrevocable does not mean unchangeable. It just means that once you make a gift to this trust, you can't take the gift back. Gifts are irrevocable, but the trust can change. It certainly will change over time. But if we're going to do that, we want to have some tools in our toolbox. So for a minute here, I'm going to talk about a few of the tools that we put in the toolbox that makes this trust very useful. And our approach here at Durfee Law Group, Estate Planning Law Group, Probate Law Group is we try to put in as many tools as we possibly can. And there's good news and there's bad news with that. The good news is for every situation that we're able to think of, we're probably going to have a tool to take care of it. But it also means that then the trust is going to be big. It's going to have lots of pages and it's going to be a little complicated. But I compare these tools kind of like the airbags and anti-lock brakes and seat belts on your car. We want those things because they keep us safe. And we hope we drive that car for its economic life and we never need the airbag, because if the airbag deploy, something bad happens. That's also the case with a lot of the tools that we put in this trust. Those tools are in there for well, what if this bad thing happens? And then if it does, well, we want something to deal with that. So I'm going to talk about a few of those tools that we can build in. One is, and this is huge, it's been our experience as a law firm working with families for decades, that if a dispute over who gets what out of the estate escalates to litigation, everybody loses. There's no kind and gentle, easy way for families to recover from litigation among family members. It blows the family apart. They become grumpy and mean, and related people don't talk to each other or see each other for decades or maybe even the rest of their life. So one of the things we can build into a trust like this is we can flat out prohibit litigation, and we can provide that if in fact somebody brings a lawsuit, they're out. They're removed. They can't be a beneficiary. They can't be a trustee. And having done that, okay, we're not going to allow litigation. At the same time, we have to recognize sometimes there are legitimate issues or problems that we need to resolve, that need to be worked through. So we can build in what lawyers call alternative dispute resolution, a process to go through to address the concern and come up with a solution that does not involve suing each other. So we do that. We use a separate agreement called an integrity agreement, which is a phased alternative dispute resolution process, which is really cool. Another thing we can build into this trust can have what are called spendthrift provisions. Now, what this means is for the beneficiaries who are whoever we've picked, it could be the spouse, it could be the children, it could be the grandchildren, a third party could have done it for our benefit, but the creditors and the liabilities of those beneficiaries cannot penetrate the trust and take the assets of the trust. That's what spendthrift provisions mean. Now, we understand it. The word spendthrift actually means a person who is a deadbeat, who incurs debts and liabilities, who doesn't pay them. So they get kicked out of the swank restaurants in Europe where they went to blow grandpa's fortune. In this instance, the spendthrift clause means we want to protect grandpa's money that he left to grandchild from grandchild's frivolous and silly and inappropriate spending binges. So the spendthrift clause, the bottom line, this is what it means. The assets in this trust can be protected from the marital problems or divorces of the beneficiaries. It can be protected from their business failures, their car accidents, their medical problems, their substance abuse problems, their bankruptcies, their litigation, their all those bad, nasty things that can happen that can result in someone losing their inheritance. And oh, by the way, I think most people know this, but I'll just throw this out there. There have been a number of studies that I cite sometimes in some of my other talks. When money moves from one generation to the next, approximately a little less than 60% of it will make it from the generation that made the money to generation 2. And it's less than 10% makes it to generation 3. And why is that? Why does the money get depleted? Where does it go? And often it goes to, well, poor spending decisions, poor investment decisions, but also, frankly, the liabilities, the unfortunate life circumstances of the beneficiaries that put that money at risk. And these spendthrift provisions can cause that to be protected. Some other tools I want to mention a few. Sometimes there's a special needs beneficiary who is qualified to receive some kind of disability benefit. If the trust is structured properly, we can protect those benefits. We can deal with issues like, well, what if a beneficiary is not a citizen of the United States? What if the trust moves? What if it owns assets in more than one place? We can make it portable and jurisdiction independent. We can employ a device called a trust protector, which is typically a neutral third party who has no economic interest in the trust. We give certain decision-making power to that neutral third party to protect the trust. And the last thing I want to mention is, of course, that this is a dynasty trust. And I want to talk about what that means. The term dynasty, sometimes it's another word that's used that means something similar as legacy or a multi-generational trust. This is a trust that's designed and intended to last for more than one generation. And for our listeners, I want you to think about something. If you have if you leave an inheritance to your children, when are they going to actually get it? And the answer is, most of the time, not until they're old. Most of us don't inherit from our parents, for example, until we're at or near retirement age. So if we receive an inheritance at or near retirement age and we blow it, we lose it. It gets gobbled up in some liability or in some bad spending or some frivolous lifestyle choices. We screwed up. We did a bad thing. We probably injured the beneficiary by letting that happen. So why let that happen? And the Dynasty Trust can actually prevent that from happening. And it can actually protect the assets so the beneficiary is provided for and cared for, but they're not going to lose the inheritance to some life disaster. So one of the ways we do that is we cause distributions to be discretionary, not mandatory. A lot of poorly designed trusts will have assets come out of the trust based on age. Oh, give them so much when they turn 30 or 35 or 40 or 45. And the problem with that is age is a poor predictor of when people are ready and capable of handling the money. And in fact, someone who might be perfectly fine when they're in their 20s to handle the wealth may not be fine when they're in their 30s and 40s and in the middle of a nasty divorce or a business issue or a healthcare crisis of some kind. So age is just a poor predictor. It's better to tie distributions to something other than birthdays. The second thing is, even smart, really well-organized people that have a healthy relationship with wealth can still end up having life disasters happen. So the trust can be structured so that, again, we can protect the principal. And often that's done by limiting the burn rate. How fast are we going to allow them to burn up the money? Are we going to limit it to the income, or to a dollar amount, or to a percentage, or some fraction of the income? And we actually have some excellent articles on our website, and I will direct you. That's our phone number there, but also you'll see our websites down there. There's one on how to make distributions from a trust last a long, long time. And there's some really powerful and cool things that can be done so that the wealth grows from generation to generation to generation, instead of being depleted by all these bad things that can happen. And by the way, what's the number one thing that depletes estates as it goes from one generation to the next? And the answer is taxes, frankly. So the dynasty also means that we take advantage of a little known and less understood exclusion from transfer taxes called a generation skip tax exclusion. Most of us are familiar with the gift tax exclusion or the estate tax exclusion, where we can give so much to our heirs when we die, and as a result, we don't have, at least on the federal level, a federal gift tax or estate tax. There's another exclusion, and that's an exclusion for a skip gift. That's a gift that goes for more than one generation. So it skips a gift in taxation and keeps going. Well, we can have assets come into this trust, take advantage of the exclusion from that skip gift tax, and the trust can last, theoretically, today forever, and keep going and growing and never realize an estate tax. And this is made possible because there's an archaic rule called the rule against perpetuities that a number of states, I think the count is in the high 20s now, have either abolished completely or limited sufficiently that we can cause this trust to last a long, long, long time. And we can also cause the trust, if we encounter a jurisdiction that would compel us to terminate the trust, we can move the trust to another place that will allow us to keep going. So we're going to form this trust. We're going to fund it. We're going to deal with the tax planning issues that we've talked about. We're going to put all the tools in it. We're going to design it to last a long, long time. And our goal here, among other things, two goals I'm going to just mention generally. One goal is to grow and protect the wealth. Goal number two is to protect the people. So we want to protect the money from the people and the people from the money, so that neither one ruins the other. And so that we get to enjoy both. We get to enjoy healthy people who have a good, positive relationship with their wealth, and a growing body of wealth, which, by the way, that's a characteristic that some families have been able to develop and create a culture in their family where the money grows, the people have a good relationship with the money, their children don't show up in public with no underwear on, they don't create scandals. In fact, you don't know who they are. They're not in the news because they're careful to stay out of the news, and they keep their money protected by doing so. So we've set this trust up. Now, what are we going to put in it? And we're going to talk a little bit about here some life insurance. And I want to be clear, we're lawyers. We don't sell life insurance. You can't buy it from us. We never get paid if you do buy it. But we do the legal planning to make the life insurance effective. And I just want to say here, life insurance, notwithstanding, people sometimes have a reptilian response to it. Life insurance, I put money in this thing, and the only way for me to win is to die. I don't like that deal. Having said that, life insurance can be a very powerful tool that can help us with tax issues, succession issues. And if we don't use it properly, we hurt ourselves, we hurt the client, we hurt their family members, and the professionals who are advising the client end up doing an inferior job. So I call that the lose-lose. If you leave life insurance out of the equation, you hurt everybody. The client, their heirs, and the advisors are doing a lousy job. And the win approach, of course, is by using life insurance appropriately, we can avoid a lot of taxes. We can create some tax-free wealth. We can provide handsomely for the heirs or the other beneficiaries, sometimes for charitable beneficiaries. And then the professionals do a good job. And if you do a good job and take good care of your clients, they like what you do and you like what you do, and everybody wins. So if we're going to get the life insurance in this trust, we have some issues. And I want to talk about the first one is, well, okay, we bought big life insurance policy in that trust. How do we pay the premiums? And the most common and the most obvious way is we're going to gift cash to the trust. Every year, mommy and daddy are going to use their annual gift exclusions and make a gift into the trust of cash. We're going to issue those crummy notices that you see up there, so the beneficiaries know, hey, mom and dad put cash in the policy or in the trust. You can take it out if you want to, and sometimes actually we recommend that clients have their children, in fact, take something out, so that we demonstrate that, in fact, the children have the power to take something out, and in fact do take something out, so the IRS can't come back and claim that it was a bogus power. They in fact had it and they exercised it. But the money that's left in that trust in that situation is in general going to be used to pay the premiums. And there's some timing issues that have to be taken into consideration. But often that's not practical or efficient, particularly when, as we see on this diagram here, the trust owns business interests. And I'm going to change the view a little bit here so that you can see that this trust doesn't happen in isolation. It's part of a bigger plan. And let's make that big there. I want that big, yeah. So this trust happens, there's going to be a revocable trust, there's going to be various business interests. And I want to point out this family bank here. And today's seminar is not about the family bank, but I want you to see this and note how it's owned. And you'll see that little green arrow right up there that says gifted. And that green arrow, if we chase it down, let's chase that green arrow down. Where does it go? Where does the green line go down to? It comes down here. And where does it go? It goes to the Dynasty Trust. So this Dynasty Trust can own a fractional share of various business interests. Now, what does that mean? It means that business entity can distribute its part of its earnings to this Dynasty Trust, and those earnings can be used to pay the premiums on life insurance. And if this trust is, as we have described, grantor defective, so it's taxed to the grantor, we're not going to incur the higher taxes of the trust. We're not going to create tax problems for the children who are the beneficiaries. Mom and dad, who are running the business anyway, are going to pick up the taxes on their personal returns. So using those fractionally owned business interests to distribute cash and pay the life insurance premiums is extremely powerful for convenience. But also, let's remember that those distributions are out of the taxable estate of the grantor, so they're not taxed as part of the estate when mom and dad die. And another significant thing, because those earnings and this trust and that fractional share of the business that is owned by this trust are not owned by mom and dad. Now, what does that mean? It means one thing for estate tax purposes, but it also means something else for asset protection purposes. If you don't own it, it can't be taken away from you if you get sued. At the same time, you can have control over it and you can be making decisions about what's going to happen with it. So this, again, plays into, under the right scenario, certain very powerful asset protection things that we can do that work really well. So we want this trust to own whatever it's going to own, the fractional share of the business interests, the life insurance, and we want them to be able to pay the taxes. Now, another thing we mentioned is that sometimes this trust can acquire assets by way of purchase. And it can buy a share in an existing business, and we can talk about that. But also I want to mention just the issue with life insurance. Sometimes we have a big life insurance policy, and this is because we're focusing on advanced life insurance issues. So I want to address this. What happens if I have a life insurance policy that's got a whole lot of cash in it? So much cash that if I gifted the life insurance policy to the trust, I would either use up part of my lifetime exclusion, or I could even theoretically trigger a gift tax. Well, what can we do? Well, one thing we can do is we can have this trust actually buy the life insurance. And there's something called transfer for value. If you sell a life insurance policy, it can cause it, under certain circumstances, it can cause the death benefit to be taxable as income. Because of the way this is structured, because of who the parties are, the life insurance, if it's purchased by the trust, is still going to be both income tax free and estate tax free. Another advanced life insurance issue is something called incidence of ownership. We've talked about how the death benefit life insurance can be included in the estate of the person who owns the life insurance. Well, how do we know who owns the life insurance? And there's two ways. One is by what does the life insurance contract say with the insurance company? Because it's going to name an owner. It's going to say the owner is X, whoever that is, mom, dad, the trust, Uncle Bob, Aunt Susie. Somebody's going to own that policy, and the contract is going to specify who that is. That's one way. The other way is we look at the practical functions of who can do what. And there are certain things under the tax code called incidents of ownership, where if you can do these things, you are deemed to be an owner. And a couple of them are, if you can borrow the cash out of the life insurance policy, if you can change the beneficiaries, if you can change the amount of the insured, so you can change it from a $1 million policy to a $500,000 policy. If you can do those things and a few other things, those are called incidents of ownership. Then even if you're not the named owner, you're going to be treated as the owner. And that is one of the reasons why the person on whom the life insurance is purchased cannot be the trustee. So the trustee, if we're buying life insurance on mom and dad can't be the trustees because we want it out of their estate. We don't want them to have incidents of ownership. But here's another advanced planning issue. Very often when we come and we're looking at life insurance as part of an overall plan, one little piece of a big plan, sometimes for whatever reason, age or health or life circumstances, mom or dad or grandma or grandpa, whoever it is, are not going to be insurable, or the cost of insurance is going to be prohibitive. And so we look for a younger, less expensive person to insure. And by the way, life insurance is one of the places where, notwithstanding whatever people say or believe politically or otherwise, where gender matters or sex matters. Females, biological females, are less expensive to insure than biological males, for the simple fact that they live longer. So it costs less to insure them. So if you want to buy life insurance and you want to have the cost of the insurance be the lowest, find a young female to insure, and that reduces the cost of the insurance. So sometimes mom and dad are uninsurable. So do they have a daughter? Okay, let's buy life insurance on the daughter. Well, what if the daughter is the trustee of this trust? In that event, then we have to segregate that policy so the daughter's not trustee over her own life insurance, because we don't want that life insurance policy included in and taxed as part of the daughter's estate. So we can accomplish that in several ways. We can have multiple trustees. The trust can expressly prohibit the daughter from exercising any of those incidents of ownership. That's just an issue we have to be aware of, and we have to structure so that we don't have an unexpected or unanticipated or accidental tax consequence. So I want to talk for a minute about now some practical things we can do with this life insurance in this trust. And there's some really, really powerful and cool things. And we're going to go through a number of examples here in our practical application phase of this. And one is, often life insurance is a device that helps manage or plan the succession of either a business or a farm or a big asset that's hard to break up. And the classic example of the farm is this. One of the family members will stay on the farm and drive the tractor for 12 hours a day and be there for decades and work the farm and hardly make any money. But then the resulting value of the farm is because of that family member's work. And the sibling that married a dentist and moved to the big city and never worked on the farm didn't contribute to the value of the farm, but is thinking, gee, when mom and dad die, I get half the value of the farm. And the one who stayed behind and drove a tractor, she's thinking, hey, I've been driving a tractor for 30 years. I get the value of the farm. So how do we fix that? And one of the answers is, well, we can use life insurance. We can buy life insurance to equalize the estate. So the one who stayed on the farm gets the farm. And the one who moved to the big city gets something else. And that something else can be part of the proceeds from the life insurance. And that can be true. I used the farm as an example, but it can also be true of the family business. You have the widget manufacturer, and one family member worked in the company and was underpaid and overworked, but their labor contributed to the value of the company, and they're expected to get the company when mom and dad die. And the family members who went off again to the big city and did other things, they're expecting half of the estate too. Well, how do we fix that? Life insurance, and we fix that through this kind of a trust. So we can equalize or unequalize benefits to the family. So another scenario, though, is we mentioned the special needs beneficiary. Sometimes there's a family member that has some special circumstance. They're incapacitated, or they have a disability, or just some life circumstance where they're going to need more care than the others that are physically and mentally able to be self-sustaining. So the trust and the life insurance that the trust owns, we can fund special things. Okay, this specific life insurance is set aside to care for this individual. We actually just had a planning situation where a family bought life insurance, and in their family, they own at least a dozen timeshares, and they use them. The whole family uses them and enjoy them, and they like them, but they're expensive. And mom and dad know they're expensive. So mom and dad are funding the timeshares while they're alive, and they're concerned that their children are not going to be able to do so when they pass. But the family wants the timeshares, even the kids want them. So mom and dad have bought life insurance and set that aside in a segregated fund specifically to service those timeshares. So that's an example. The life insurance can also be used to provide for a spouse. We particularly see this where there's disproportionate ages in a spouse. And a story that's mostly true, slightly edited to protect the privacy of the people that were involved. I had a client in his 80s, his wife passed away. And shortly thereafter, he comes into my office with a young woman that I will say her name was Candy. And she was a quarter of the age of this gentleman. She was in her 20s, he was in his 80s, and she was wearing a very little dress. And Daddy Warbucks, the client, said, Rick, I'm going to marry Candy here, and I want to give her my house. Now, because of some planning that we had done, the house was actually in a trust that had to go to Daddy Warbucks' children. It could not go to Candy. So it was just, we couldn't do what he wanted us to do. So Daddy Warbucks got mad when I told him, you can't do this, dude. You're not allowed to under the terms of the planning that you've done before. Your wife set it up specifically to prohibit you from giving the house to Candy. And that's how it's going to be. So Daddy Warbucks got mad at me, pounding on the table, telling me, Rick, you dirty, rotten scoundrel. If you don't figure out a way to do this, I'm going to fire you. Well, I changed the subject, and a few minutes into the meeting, Candy excused herself to go to the restroom. And as soon as she was out of the room, Daddy Warbucks leans over the table and says, Rick, you got to help me. I said, what do you mean? He goes, I don't want to give Candy my house. I said, dude, you just insulted me for telling you couldn't do it. What's going on? And he goes, well, Rick, you've seen Candy. I want to marry her now. I've only got so many clicks left. I'm 80 years old, for goodness sakes. And if I don't give her the house, she won't marry me. So what can we do? Well, I asked him, are you healthy? Well, he's healthy enough that Candy's interesting. So sure enough, we turned out that he was insurable. We called his insurance guy. we set up an irrevocable dynasty trust like this for the benefit of Candy, and Daddy Warbucks bought Candy a life insurance policy. Now, in fairness, Daddy Warbucks is still my client, and so is Candy. And when Candy came back in the room, she said, "Look, sweetie, I love you, but I have nothing to give you except for my youth and my beauty. And if I give you my youth and my beauty, and when you die, then I don't have youth or beauty anymore. Who's going to want me, and how am I going to live?" So it was a win-win situation. By the way, Daddy Warbucks looks about 10 years younger than he used to, and is doing really well. But the point is, we use the Dynasty Trust and the life insurance to protect the marriage, to make the marriage possible, to make sure that the children didn't get disinherited by Daddy giving the house to Candy. Some other things I want to mention. In fact, I should mention this. This is another real life client situation. Again, the facts are changed to protect the client. Client was shown, "Hey, we should do a dynasty trust like this." The client said, "No, I'm not willing to pay the lawyer that fee. What a silly fee. What a stupid thing. I'm not going to do that. I'm smart. I've got this figured out." So Daddy Warbucks in this situation had two sons. He gifted the money to his sons, and the sons bought the life insurance in their own names. So now, okay, the life insurance is out of Daddy's taxable estate, and the sons are paying the premiums with gifts. So every year, Daddy gifts death benefits to the sons. And a couple things happened. In fact, I'm going to tell you two different scenarios because I've had both these happen. The sons, by the way, get the gift from Daddy to pay the life insurance premiums, and they deposit that gift in the only checking account they have, which is a joint checking account with their wife. So they commingle the funds with their marital assets and pay the premiums then with funds from a joint account. Ouch. Now, in one of the situations, one of the sons died and he was the owner of the policy. Now who owns the policy? And we have this huge dilemma. Okay, we didn't expect Junior to die before Daddy did. And so it's complicated and expensive to go unwind this. And the wife is saying, "Yeah, my husband died. I own the policy now. I get to decide what's going to happen with it." And it's a complicated mess. We had another scenario where one of the sons owned the policy and the other son didn't own it, but Daddy said, I'll trust you to share half with your brother. And Daddy dies. Brother owning the life insurance policy collects the $2 million. The son's wife says, "Gee, I've been unhappy in our marriage for a decade, and it was never worth divorcing you until now." So she divorced him. And because the policy was paid for with marital assets, guess how much of the life insurance she got? Half of it. So now Sonny Boy only has half the life insurance, and his brother comes knocking on the door saying, "Hey, where's my half?" And he says, "Well, my ex-wife's got it." So again, a nasty family situation. Having the Dynasty Trust own that life insurance policy avoids a lot of these ugly situations. A couple of other quick things that I want to touch on here. Life insurance can be used in what's called buy-sell arrangements. If you own a business with multiple partners and you want to be able to buy out the partner if they die so that you're not in business with the partner's spouse, that's called a buy-sell agreement, and that can be funded with life insurance. And that life insurance, most of the time, needs to be owned in an ILIT. And if it's going to be an ILIT, it should be a good ILIT. It should be a Dynasty ILIT. So, and there's some interesting ways that can be done. If you have more than two partners, sometimes we'll use a life insurance LLC under the Dynasty Trust to own the life insurance and make that happen. Another interesting thing, some of these I'm going kind of fast over because I just want to make you aware of the issue. And if you encounter this issue, you don't need to know the solution. You need to know that there is a solution, and you know a guy to call that has a solution for that. So that buy-sell is one solution. Another interesting thing, this was far more popular in the 90s than it is today, although we still see it once in a while. And that's something called a split dollar arrangement. And that's an arrangement where a business pays the premiums, and those premiums are part loan and part income attributed to the employee. And if the employee were to die, the business gets back what it loaned. The employee gets the death benefit for the the part of the premium that was paid with after-tax dollars. So that split dollar planning is an interesting alternative that we can do. I want to talk specifically about a Dynasty ILIT and life insurance policies to bail out an existing IRA or to as an alternative to IRAs. And then we're going to talk about, well, how the heck do we get the money out of the Dynasty Trust? So,
hey Rick. Rick, before we get into that, I just wanted to can you bring that diagram up again?
That's what
I just wanted to, for those who are listening, as you kind of take a look at this, this isn't all encompassing, but it's fairly close. And there's a lot of people who are either listening or who are clients of those who are listening who may need this type of planning. And typically what we do is when somebody comes into our office, we don't just look at one portion of their life, but we try and look at their finances, and we try and look at whatever businesses they own and kind of get the whole picture so that we can help them in what we refer to as integrated planning, where we take everything that they have and we try and fit it together nicely so that there's no gaps in the planning that's done. And in that way, we can provide them with as much protection as they will allow us to. And we also provide them with a plan that will help them transfer their assets to the next generation. The other thing that I wanted to just share briefly is that we're at the beginning, I think we mentioned that there's a comment section here. For those of you who have come a little bit later, if you have any questions for Rick or for me, based on the things that we've already talked about or anything else that you want to ask a question about, we have a comment section where you can ask those questions and we'll try to give answers to those.
Thank you, Mike. I want to add, Mike is an awesome attorney. We're excited and pleased to have him on our team at Durfee Law Group. And he could say everything that I'm saying. I hog, I guess. I'm a microphone hog and I talk too much. So Rick is a very talented attorney and a wealth of information. So I'm glad to allow him to take the lead role. So I'm going to point out something here, and I appreciate you reminding me about the diagram we have up here. I want to pull up and show you a specific detail on our diagram here. By the way, we create custom diagrams like this for all of our clients so that we can see their family members and their entities and their structures and what they have going on here. I've got this IRA on the diagram. You can see this. And we encounter people a lot that have what I believe is accurately described as an overfunded IRA. Now, what's an overfunded IRA? What does that mean? Well, I want you to remember what IRA stands for. Individual Retirement Account. So it's an account whose statutory purpose is to pay for the retirement of an individual. And that paying for the retirement of an individual, the owner of the retirement account, and that can include a spouse, that is the most tax efficient use of an IRA. An IRA is a terrible device, an extremely inefficient device for leaving wealth to the next generation. And why is that? And I'm going to illustrate this with an example from a recent person that we dealt with. They have a very large estate, large enough that they're going to have an estate tax. And they have an IRA with several $1 million in it. And because their estate is subject to an estate tax, and their IRA is over the estate tax threshold, between income taxes and estate taxes on that IRA, we did the math, and it's going to clock in somewhere between 65 and 70% of the money is going to go to taxes in the IRA. So the client's thinking, no, my daughter's going to get my $3 million IRA. No, she's not. She's not going to get it. The IRS is going to get it. So what can you do with that? Wait, but I want my daughter to get $3 million and I'd like her to get it tax-free. Well, remember, IRAs, traditional IRAs in particular, have pre-tax dollars in them. So when the money comes out, you pay an income tax. And if your estate's over the estate tax threshold, you pay an estate tax. So how could we get $3 million to his daughter tax-free with this IRA? And here's how. I'm going to tell you the short answer. We did some cool things. We had Daddy take distributions out of the IRA. Daddy takes distributions out of the IRA, and what does he do with them? He does a couple things. Number one, he pays whatever his taxes are on that, which is fine. Number two, he takes the leftover money after he paid his taxes, and where does he put it? Right here in the Dynasty ILIT. It's a gift, and we do the crummy notices. And what does he do with that gifted money in the Dynasty Trust? He buys $3 million worth of life insurance. So now what happens? What is his daughter going to get when he dies? $3 million, income tax-free and estate tax-free. Hurrah! What about the IRA? Does it go away? No. We'll come back up here. He still has the IRA. What if he needs it for his retirement? Because he thinks he's going to need it. He's not going to. The other $20 million he has isn't going to be enough. So I might need that money. Okay, if you need the money, there it is. You got it. You can take it and spend it. So he still has it during his lifetime. Well, how do we cause the IRA to pay zero taxes when he dies? We want whatever's left in that IRA on the day Daddy dies to pay zero taxes, no estate taxes, no income taxes. What do? Well, we've already talked about how we're going to create $3 million tax-free for the daughter. We take the IRA and we name as the beneficiary a family foundation established as a donor-advised fund. And I've shown Legacy Global up here. They're my favored organization, but you can get donor-advised funds at Fidelity or Schwab or Vanguard or your favorite church or your favorite university. There's lots of places to get a donor-advised fund. And this is not a conversation about donor-advised funds, but I just want to point out that in conjunction with the Dynasty Trust down here, we can cause that IRA where we're going to lose 70% of the value when Daddy dies. We can capture that value. We can create an equivalent value that's tax-free for the family member. And we can capture whatever dollars would be lost to taxes and have them go to Daddy's charitable mission so he gets to support charities that he likes. So everybody wins. Daughter wins, Daddy wins, and Daddy's charitable causes win. It's a cool thing. That's the IRA bailout. I also want to mention this one thing, and this is for. Oh, by the way, in answer to a question, you'll see that does the type of IRA change things? Yes. A Roth IRA has after-tax money, so you've paid the taxes on the front end, and then on the back end, you don't have taxes. And there's a lot of people pressing you to convert your traditional IRA to a Roth IRA. And there are times when that makes sense. But there are times when it doesn't make sense. And this is, I believe that math rules. Let's do the algebra. Let's calculate. If you convert to a Roth, what do you net? What do your children net? If you don't convert to a Roth, what do you net? What do your children net? And if you use life insurance in the mix, who gets what at the end of the day? And let the high number dictate what you do. Whichever one of those scenarios produces the high number for you while you're alive, and the high number for your heirs when you're dead, and the high number for your charity, the big number wins. That's what we do. And it's not always the same plan. Different people, different ages, different health capacities, different amounts in their IRA, different mix of other assets. So we actually need to do the math to know what's the right solution for somebody. But I want to mention an alternative, and I kind of share with you an idea, something that not a lot of people think about, but this should be clear from what I'm going to tell you. IRAs are a creature of what? Where do IRAs come from? Who made up IRAs? And the answer is politicians did. It's a political device. So here's a principle for you, and this is important. If you understand this, it will give you a lot of power in your life. The people who make the rules can change the rules, and they will. And the new rules are probably going to be in their favor. That's more likely than for the new rules to be in your favor. So we've just had an example of this with IRAs, a change in the rules called the Secure Act, which has a bizarre acronym that means the opposite of what the law actually does. In fact, the Secure Act is a tax hike on IRAs. It used to be, prior to the Secure Act, that you could give this IRA to your daughter or your son, your children, and they could stretch. It's called stretching the IRA. They could stretch the required minimum distributions out over their life expectancy. So whatever their age was, they could take that IRA out for as long as they lived, and that in that scenario maximized the tax deferral of the IRA and maximized the cash benefits to the family members. Well, for a long time, people say, "Oh, this is a great idea," and I kept saying, "Hey, the politicians can take that rule away," and guess what? They did. Now they require IRAs to come out in 10 years. After you die. So for a non-spousal beneficiary, daddy dies, mommy dies, they're gone now, the IRA is going to go to the kids. How long can the kids stretch out the IRA? The answer is maximum 10 years. It has to come out in 10 years. So that tax deferral for a lifetime is gone, which, by the way, raises the taxes on IRAs and is really cool. So the politicians could tax IRAs without making a tax hike. They didn't call it a tax hike. It's not a tax hike. It's just they took away the stretch. So as an alternative to that, you can use life insurance, often owned by a trust like this, as an alternative to a retirement plan. And this is not for everyone. If you have an employer, if you're an employee and you get matching contributions to your IRA, take as much as you can possibly get. Maximize that baby out. But if you're the business owner, if you're the entrepreneur or the professional, think about this. There are private contractual alternatives to an IRA that produce the same benefit. And one of them is low death benefit, high cash value life insurance owned by a trust such as this. So low death benefit, why that? The internal cost of a life insurance policy is based upon how much death benefit is provided. So if we keep the death benefit low, the internal cost of the life insurance is going to be low. Then high cash value, why that? Interestingly enough, there are a few things in the law that are not tax deferred, but tax exempt. IRAs, people think, "Oh, my IRA is tax free." No, it's not. It's tax deferred. So you are going to pay a tax on it someday. Even a Roth IRA is not really tax free. You pay taxes on the front end instead of the back end. So it's still after tax dollars. Life insurance is one of the few things that are tax free. Churches, 501c3s, there's a few things that are tax free. Life insurance is one of them. So with this low death benefit, high cash value policy, you can push cash in it. And there's a limit, there's a ceiling of how much you can do depending on your age and the amount of the insurance. And that cash can grow, and that growth of that cash is tax-free. And when you need that cash, or if you need that cash in your retirement years, you can borrow that cash out of the life insurance, and that's tax-free. And then if you die, or when you die, we should say death is a when question, not an if question, the death benefit pays and it goes to your beneficiaries under the Dynasty Trust, and the death benefit is tax-free. Tax-free is better than tax deferred. So I went over that really fast, but there's using low death benefit, high cash value life insurance for the entrepreneur, the business owner, is a powerful alternative to IRA and traditional IRA planning. So now this raises a question, and this is a very important question. We're gonna deal with two more big questions. How the heck do we get money out of this Dynasty Trust? Question number one. And question number two is, How do I get a Dynasty Trust? Or what if I have an ILIT and it's a stinky bad one? It's too old and doesn't do these cool things. So question number one, how do we get question out of the Dynasty Trust? So we're still, this is part of our practical applications. And I'm going to tell you, there's at least 6 or 7 ways, and I'm going to run through these. So remember, the children, the beneficiaries, they can get the cash out anytime. Who's wanting the cash? Mommy and daddy over here, the people who own the policy. So how can they get the cash out? Well, here's method number one. The trustee of the trust can borrow cash out of that high cash value, low death benefit policy, distribute the cash to the children, and the children can make upstream gifts to mommy and daddy. Most gifts go downstream. Parents gift to children. In this instance, the children can be the ones who gift to mommy and daddy. Option number 2. The trust here, this Dynasty Trust, can buy assets from mom and dad. So mom and dad own a house, they own a business, they own the farm in Iowa, they own the cabin in the mountains, the condo on the beach, whatever, they own something. And we want to keep it in the family, and mom and dad need cash. And so we'll have the Dynasty Trust buy that asset from mom and dad. It stays in the family. Now it's owned by the trust, and it's controlled by the trust for the benefit of the children, and mom and dad got cash. So buying assets from mom and dad. That works especially well with heirloom properties and family businesses. Option number 3, the trust can buy assets for the family. So I see this a lot. The family's been progressing and growing financially, and mom and dad say, gee, we want to buy that heirloom property. We want to buy a cabin in the mountains as a family retreat. We want it to be in our family forever. It's going to be for the benefit of our children and grandchildren, but we'd like to spend a couple of weeks there every summer. So guess what? Dynasty Trust can borrow that cash out of the life insurance policy. It can buy the cabin in the mountains. It owns the cabin in the mountains. It's for the benefit of the children and the grandchildren, but the children and grandchildren can invite grandma and grandpa to come stay there for 2 or 3 weeks in the summer. Option number 4, the trust can loan money to mom and dad. And I'll tell you a classic example of this, and I'm going to make the diagram big again so you can see this. So mom and dad own an asset. And a classic thing is a residence. And mom and dad are going to own their residence. Let me pull this over here. They're going to own their residence right over here under the revocable trust. You see personal residence right there under the revocable trust. That's where they own that residence. And we want that residence owned there to avoid probate and lots of other things. Well, mom and dad have a whole bunch of equity in this residence. They want to continue to live in the residence. They want to continue to own the residence, but they need cash. So we can put a reverse mortgage on this residence. And you've probably heard of those. All you real estate professionals out there listening know about them. And I'm going to tell you just in general, with rare exceptions, I hate reverse mortgages if you're going to go buy them from a third party, because it has the effect of disinheriting the children. But in this case, the reverse mortgage is good because who is the lender going to be? We're going to put a reverse mortgage on the house, and the lender is going to be the Dynasty Trust. It's going to loan money to mom and dad, and it's going to take a mortgage out on their house, a revolving credit line, a home equity line of credit, and it's going to secure that mortgage with a deed of trust. So now mom and dad get what? They get cash out of the trust. And what happens to their equity? Their equity in the house is ultimately going into the Dynasty Trust. But it's not purchased. It's because of the loan. So when they die, they have to pay back the loan. But the other thing they get, which is really powerful, because mom and dad kept ownership of the house up here in the Revocable Trust, right here. When mom and dad die, they get a step up in cost basis on that personal residence. So the residence can be sold after mom and dad die with 0 capital gains. You repay the loan to the Dynasty Trust, which goes there tax-free. That's pretty cool. And we've got it out of their taxable estate. So if their estate was large enough that they would pay an estate tax, they pay no estate tax. So what did we accomplish? We got cash to mom and dad. we got a valuable asset out of the estate, and we got tax-free benefits for the children. So that was, I don't remember what our count was, 5 or 6 on ways to get money out of the taxables, out of the Dynasty Trust. Way next, whatever our count is, to get money out of the trust. This trust can make capital contributions to business entities. Now remember, we showed you this green, the business interests that are owned right here. We trace that green line up there, and where does it go? This trust owns a piece of what? It owns a piece of this limited partnership here. This could be an LLC, but it owns a piece of this. It's a partner in the business. So that trust can make a capital contribution to the partnership. So the trustee of the Dynasty Trust borrows cash out of the life insurance policy and strokes a check or does an online transfer to the limited partnership. Now, who's in control of the limited partnership? And again, this is a discussion about trust, not partnerships, but the short answer is mom and dad. So the cash comes into the limited partnership, and what can mom and dad do with it? They can invest it in a property. They can pay themselves management fees. They can loan it to themselves. They can pay off the mortgage on the rental property. They can do all kinds of things in that limited partnership. The bottom line is they have control over it now. So we move the cash in there. Now, option next, I think there's 2 more ways. This trust down here can also capitalize a new business venture. And I'll give you an example of this from real life. Had a client, the husband passed away, big life insurance policy paid in the trust. And the wife said, I know this is a little weird, but I've always wanted to drive a truck, a semi-truck, a big one. And so we said, okay. So the Dynasty Trust formed a brand new company, a trucking company, and formed an LLC as a trucking company. And it put a part of the life insurance proceeds in that trucking company, and it bought a truck. And then mom went out and got contracts and started driving truck. And she drove a truck for a year. And after a year, she said, I've had enough. I'm done now. But in the meantime, they had a whole bunch of trucking contracts. And so they started buying more trucks and getting more contracts. Today, that company has many, many, many trucks and is doing millions and millions of dollars worth of business and is paying mom a healthy salary. Mom doesn't own the company. The trust does. The Dynasty Trust does. It's out of mom's taxable estate, and mom's doing stuff she loves and enjoys and getting paid to do it. I think that was actually the 6th way. The 7th way now that I'll mention is when we build in these grantor defective tax provisions that you see right there, one of those is that the trustees of this trust can swap assets. And it's different than a purchase. There's some different tax consequences. But the Dynasty Trust can say, hey, we have this asset and you have this other asset. Let's trade. And if they're equivalent value, they can swap them. And so that's how way number 7 that we can get out of money out of the trust. So can this trust act like a bank or a partner? Absolutely. The trust is a partner in this partnership agreement that we showed you. And sometimes you will see here, in fact, we had with this trust, we call it sometimes the limited partnership, we call the family bank. In this instance, in this complex plan where we have multiple structures, we've identified this business limited partnership as the family bank. But in simpler situations where we don't have business entities, this Dynasty Trust here, it can be the quote unquote family bank. It's got the money. It's going to make loans to the family members. And by the way, an interesting thing on, well, how does the family use this trust? In fact, I've got a little thing over here. We can set the burn rate to principal and income, give them everything, or limit it to the income, or a fixed percentage, or the net income, or a dollar amount, or a fraction, or the loans only. So this trust can loan money to the beneficiaries, secure the loans with the deed of trust. So it can loan money to the kids. It's functioning just like a bank. So let me use the example of kids want to buy a house. We're going to talk about this, and then we're going to talk about how to fix this trust if it's wrong. Junior and Missy here they want to buy a house, and there's money in the Dynasty Trust. How can Junior or Missy buy the house? 3 ways I'm going to walk through with you here. Way number 1 is if the trust has the money, and if you've given the trustees sufficient discretion, the trustees can just distribute cash over to Junior and Missy here, and they can buy the trust. Well, which is fine, except I want you to think about this. As soon as the money comes out of the trust and comes over to the daughter here, it loses all the protection of the trust. So all the stuff we've talked about, all the dynasty provisions and the spendthrift provisions and the multi-generational tax-free growth and all that, gone. So, well, maybe that's not the best thing. So the trust, then, option number 2, the trust can just buy a house and let the daughter live in it. It owns the trust, but the daughter gets to enjoy the benefit of the house. This is really cool. So daughter gets a house and she'd have to pay for it. Trust owns it. But let's say daughter's husband goes, wow, sweetheart, that's really cool that your trust can buy a house, but I'm a little uncomfortable with your trust owning our house. We're married. We should be building some equity together. Okay, that's actually reasonable and appropriate. Shows some self-reliance and some independence. So daughter and hubby here, you guys go buy the house and the trust will be the bank. It will loan you the money on the house. It will secure the loan with a mortgage, with a deed of trust, just like any other lender would be. And you have to make house payments. And where do the house payments go? Back to the trust. Now let's go through some scenarios. Let's say in our example here that hubby turns out to be a decoy or a deadbeat. By the way, what's the probability that the children are going to experience a divorce? And the answer is, it used to be 50%. With COVID, it's actually up. With people having to spend all day together with each other going, hey, this isn't working, I'm out of here. So at least half the marriages of generation 2 are going to end in divorce, sadly. And nobody likes that, but it's a fact. So if hubby turns out to be a decoy or a deadbeat and he leaves, what's going to happen? Well, scenario 1, let's say he leaves, but he's a decent guy and he continues to make the house payment. Okay, the house is going to be sold or the trust can buy him out. His equity is going to be shared or saved, and he's going to get his equity because he put money into that. But let's say, like what happens in many divorces, there's financial stress, and he says, why should I make house payments on this dumb thing? It's going into her trust anyway. I refuse to make the payments. Well, when they stop making payments, what's the bank going to do? It's going to foreclose. It forecloses on the house. It takes it away from daughter and her husband. They don't own it anymore. Who owns it now? The bank does. What's the bank? The trust. And what's the trust, the bank, going to do? Well, the daughter's a beneficiary of the trust. So the bank's going to let the daughter live in the house. But we're going to scrape off the deadbeat ex-husband who's gone now, out of the picture. So we protected the house. That same protection would also apply for a third-party creditor, which is kind of cool. So that's an illustration of something we can do with that Dynasty Trust. Now, we're going to wrap up here. I want to hit a couple of little things. What happens if, well, we have an ILIT, but we set it up years and years ago, and it doesn't have all these, doesn't have the Dynasty stuff, doesn't have lawsuit avoidance, it's paying taxes, it's old, it's obsolete, it's broken, it's bad. What can we do about it? And there are some very cool things we can do. And this used to be, you've always been able to do this, but there are some lawyers who, for whatever reason, even though things are allowed, if there's not a law somewhere that says it's allowed, they don't know that it's allowed, so they think it's not allowed. But in fact, it's allowed. Well, this particular device that I'm about to talk about now, it's always been allowed, but now there's a statute that says it's allowed. So lawyers that used to be skeptical and think it couldn't be done, now they recognize, oh, it can be done. And here's what it is. It's called a decant. That's where we have the old trust that's bad, and we have a new trust that's good. So we form a brand new trust that's got all the good stuff that you want in it. And we have the assets from the old trust decant into the new trust. So you know what? Decanting, it actually comes from, I think it's brandy. You pour the brandy into a decanter. So you get it into this little bottle. You actually aerate it because it makes it taste better, I guess. I don't know. I've never tried that. But that term, pouring it from one bottle into the other. So we're going to pour the old trust into the new trust. So we can decant that old trust into a new trust and upgrade it and fix it. So if you have an old one, don't despair. We can fix it. Well, what if we set one up 12 years ago when the estate tax exclusion was only $600,000 or $1 million, and we needed it then, but we don't need it today? So what if we have one and we want to get rid of it? Can we do that? And the answer is yes. There's been a number of plans where we're actually seeing quite a bit of this, where, again, 15, 20 years ago, we did some planning because it was right at the time. But now with new laws, the family's changed. They're older, the client's older, their business activities changed, their risk profile has changed, their tax profile has changed. They want simple. We can unwind these trusts too, and we can do a family settlement agreement that distributes things out and takes care of it. So we've covered a lot here today. We've covered, what is this Dynasty Trust? Who needs one? How does it work? What kinds are there? How does it get money? Who pays the taxes on it? What kind of tools are included in it? When it owns life insurance, what kind of things can we do with the life insurance? We've covered all kinds of things we can do with the life insurance. And we've covered how can it be used for the benefit of the family members? How can we get money out for mom and dad? How can we get money out for the kids? And we've talked about how do I update or upgrade this. So now we get to the final question. So what? You've heard about all this. Odds are either you need one of these, or as a professional advisor, if you're a professional advisor listening to this, you know somebody who needs one of these. So a couple things is, one is get smarter, learn about it, educate yourself. We have a number of articles that you can get. Actually, you can go to our website. There's tons of stuff on our website, but there's a few articles that the only way you get them is to ask us for them. And I'm going to tell you two of those. One is called Why All Trusts Are Not Created Equal. It's a lengthy white paper. It's too big to put on our website. If you ask for it, we'll give you one. The other one is Leave Your Estate to Your Children Without Ruining Them. We talk about some of the things that happen with inherited money that really mess up generation 2 and 3 and 4, and how to avoid that. And using a dynasty trust is part of the solution. Those are two articles we will send you. So if you email us, you can go to the websites that you see in the banner down there below, or email us at info at any one of those, or call the phone numbers that you see here. Here's Estate Planning Law Group. There's their phone number. And Durfee Law Group, there's their phone number. You'll know something and familiar with all these. They all end in 8,000. So if you can remember 8,000, there's a prefix, you'll get to us. 535-8000, 324-8000, 935-8000. It gets to us. And you can request those articles. We're happy to send them to you. If you are a professional advisor, we offer complimentary meetings for you and your clients. If you're an end user and you go, well, wow, I might need one of these. I have a big business, or I'm concerned about asset protection, or I own a bunch of life insurance, or I have a complicated business structure and I need to integrate generation 2, or I have family issues that are going on that I need to do some planning beyond a simple revocable trust, then come visit with us. I guess the so what action is this. And I want to say this in the final thing. As you've listened to this today, something has popped into your mind. I should do something has popped into your mind, whatever that is. And it'll be different for every listener. Whatever that is, right now, write it down. What was it? I should call mom. I should order pizza for lunch. I should whatever. I should call my CPA. I should go look at my trust to see if it does these things that I want. Whatever it is, I really should do that. Write it down, and then before the day is out, do that. And it will be the right thing for you, because your subconscious mind fed you whatever is right for you. And one of the things I suggest that might be on your list is to learn more about this stuff. Go to our website, get some of these articles. Mike, Do you want to add anything here? I've really hogged the microphone. What would you like to add as we wrap up here?
I don't think I have anything to add. I just want to encourage anybody who's been listening to ask us any questions you may have, or I can put our emails in the comments section if any of you would rather email as opposed to call us if you have a question. Certainly we're glad to respond to whatever you want to know about.
I see that more than one person has suggested that pizza sounds good. Where can we get our piece? So sorry for injecting the pizza idea. We've been talking long enough. People are hungry. We enjoy these seminars. They're a heck of a lot of fun. It's not quite as fun as being in person. I'll be honest with you. I like to be able to interact with people, and sometimes we get more questions when we're face to face. People are a little less reserved and willing to come forward and ask questions. So if you have questions after the fact, or if you happen to be viewing this online when it's not a live broadcast, get a hold of us. We love questions. It makes our day much more interesting. See there, Mike at DurfeeLawGroup.com and Rick at DurfeeLawGroup.com. That gets to us directly. If you want to get a hold of our staff or do some scheduling, if you do info at DurfeeLawGroup.com, it'll get to us as well. So it's been great to be with you. Hope you enjoyed this. Hope you found it useful. This is a little bit of an esoteric topic. It's an odd topic, I suppose, but it's a very powerful planning tool, this Dynasty Trust, and we hit a whole lot of information in a very short period of time, even though it may have felt like a long time. So it's been great to be with you. Thank you.
Thanks, everybody.